Hello, and welcome to the Commodities Institute podcast. I'm Emily Costa, and today is February 18th, 2026. Thank you for joining me for a deep dive into the forces shaping global commodity markets right now. There is a lot moving beneath the surface today, and I want to slow this down, unpack it carefully, and connect the dots across energy, agriculture, metals, carbon, and freight in a way that makes sense beyond the headlines. I want to begin in South America because one of the most consequential oil stories right now is unfolding in Guyana. For years, Guyana has been described as a frontier success story, but the tone has shifted. This is no longer just about promise. It is about scale, timing, and geopolitics lining up in a rare way. Guyana's oil sector is entering a new phase as tensions with neighboring Venezuela appear to be easing following political there. The removal of President Nicolas Maduro has changed the regional risk calculus almost overnight. For Guyana, that matters because a long-running border dispute has constrained exploration in parts of the massive Stabroek block. With that risk diminishing, investment hesitation is fading as well. At the Guyana Energy Conference in Georgetown this week, President Irfan Ali laid out an ambitious vision that goes far beyond oil. He spoke about using energy revenues to finance airports, a digital payments platform, even a domestic stock exchange. This is the kind of talk you hear when a country believes its oil income is durable, not fleeting. The backbone of all of this remains the Exxon-led consortium operating offshore. ExxonMobil has already helped lift Guyana's production capacity above 900,000 barrels per day, with another project expected to push that closer to 1.15 million barrels per day. That puts Guyana in a league few would have imagined just a decade ago. What is equally important is what might happen next. If the force majeure covering disputed waters is lifted, additional exploration could significantly expand reserves beyond the current estimate of 11 billion barrels of oil equivalent. Chevron's recent entry into the project has only added to that sense of upside. This is how oil provinces mature, quietly at first, and then all at once. Now let's pivot to Asia, because while Guyana represents supply growth, Asia continues to define demand. February crude oil imports into the region are tracking at record levels, and the numbers are striking. According to shipping data, Asia is pulling in more than 28 million barrels per day by sea this month. China and India remain the engines of that demand, but what is changing is where the barrels are coming from. India is the clearest example of geopolitics reshaping trade flows. New Delhi has committed to reducing its reliance on Russian crude as part of a broader trade understanding with the United States. The result is a sharp drop in Russian barrels heading to India in the coming months. Those volumes do not disappear. They are being replaced, and the biggest winner so far appears to be Saudi Arabia. Saudi Aramco has lowered its official selling prices for Asian buyers, making its crude far more competitive. India's imports from Saudi Arabia have jumped to levels not seen in years, and China is also lifting purchases. Russia, however, is not losing China. Beijing continues to buy heavily discounted Russian oil, underscoring a theme we keep returning to on this podcast. Price often outweighs politics in commodity markets. From oil, I want to move into agriculture, where the United States is processing soybeans at a blistering pace. January's soybean crush reached a record for that month, driven by expanded processing capacity and strong demand for vegetable oil from the biofuel sector. Crushers are running hard, but the byproduct of that effort is swelling soy oil inventories. This matters because policy uncertainty is creeping back in. The US Environmental Protection Agency is expected to send proposed 2026 biofuel blending mandates to the White House this week. The range under discussion for biomass-based diesel is slightly lower than earlier expectations. Even a modest adjustment can ripple through fuel credit markets and soybean oil demand. Farmers, crushers, and refiners are all watching closely because mandates set the tone for investment decisions years down the line. Let's turn now to metals, where a less visible but potentially disruptive story is unfolding in global logistics. An arbitration claim against the owners of Access World has raised concerns about the stability of warehouse operations tied to the London Metal Exchange. Access World controls a significant share of LME-registered metal stocks, particularly copper. If financial pressure were to disrupt warehouse operations, the implications could extend well beyond one company. Metals markets depend on trust in storage and delivery systems. Any doubt about access to physical inventories can tighten liquidity and inject volatility into prices, even if the metal itself is fundamentally abundant. This is a reminder that infrastructure risk can matter just as much as supply and demand. Staying with metals but widening the lens, India is now actively seeking new export markets for its steel as Europe's carbon border tax begins to bite. The European Union has long been India's primary steel destination, but carbon costs are eroding competitiveness. As a result, Indian mills are looking toward the Middle East and Asia, regions where infrastructure spending remains robust and carbon constraints are looser. This shift is not just about exports. India is also scrambling to secure raw materials, particularly coking coal, through long-term offtake agreements and overseas asset acquisitions. Dependence on imported coal remains extremely high, and competition for those resources is only intensifying. Before we wrap up, I want to touch on carbon and power, because this may be one of the most politically sensitive commodity stories of the year, US. Liquefied natural gas exporters consumed more natural gas last year than the entire residential sector. That is an extraordinary statistic. LNG exports have become one of the fastest growing sources of gas demand, tightening supplies and pushing prices higher for everyone else. Households are feeling it through higher heating and electricity bills. Power generators are feeling it through fuel costs. And with elections approaching, the optics of exporting energy while domestic prices rise are becoming harder to ignore. LNG exporters remain highly profitable, but that very profitability could draw scrutiny and calls for restraint as new export capacity comes online. Finally, let's end with dry freight and trade flows. At the Port of Los Angeles, exports have fallen to their lowest level in nearly 3 years. Shipments to China, particularly agricultural products like soybeans, remain deeply depressed under the weight of tariffs and retaliation. Imports are holding up for now, but the imbalance tells a broader story about how fractured global trade has become. So when you step back and look at today's commodity landscape, a common thread emerges. Geopolitics is no longer a background risk. It is actively reshaping supply chains, investment decisions, and price formation across markets. That is where we will leave it for today. If you found this episode valuable, be sure to subscribe, share, and leave a review. Thank you for listening, and I'll be back tomorrow with more perspective from the heart of the commodity markets.